We start with an overview of a hectic weekend in March of this year. It was the FCA's Financial Conduct Authority Chief Executive, Nikhil Reddy, who outlined the assessments in a letter to MPs on the Treasury Committee. It all started with a bank run on SVB UK's deposits, and ended with authorities facilitating HSBC's takeover of the bank. SVB UK had nearly 3,000 staff, and it was the FCA's responsibility to assess the potential impact of the bank's potential failure. Their team swelled to more than 60 staff over the weekend in question and started assessing the potential impact. Given the panic over the health of the California-based parent company, many of its staff members decided to pull their billions of pounds in funds from their accounts. As a result, the FCA identified that SVB UK held deposits for over 130 firms regulated by the FCA. It was also clear that a number of FCA solo-regulated firms would have faced operational and liquidity problems if SVB UK went into administration, and potentially caused them to collapse. To make matters worse, the risk of the cascade of domino effect was very real. Thankfully, the UK authorities including the Bank of England got together to intervene and facilitate HSBC's takeover of SVB UK. This prevented the domino effect which would have put many other regulated firms in the city at risk of failure. More worrying, consumer outcry soon started and the FCA team went up to more than 60 staff, who worked overnight and over the weekend. They started proactively contacting regulated firms to alert them to the situation and understand the impact that SVB UK's failure might have on their operations. The FCA also waived their usual anti-money laundering checks for high street banks. The episode also raised a number of concerns for the regulator. These include the impacts of the steep interest rate hikes on some financial firms, the speed at which the panic spread throughout the financial system, and whether deposit insurance schemes are fit for purpose. Meanwhile, consumers were also feeling the ripple effects, and the FCA reminded firms to provide appropriate support to those consumers who are at risk of experiencing financial difficulty. In separate news, the NatWest chairman, Howard Davis, announced his retirement, ending a near-decade-long tenure that included one of the biggest corporate turnarounds in UK corporate history. Investment banking giant, HSBC, was identified as the likely savior, and just hours before markets opened the sale was completed. In the end, the banking sector feel lucky that this sale was able to take place, and if it hadn't, the effect would have been devastating. In conclusion, the FCA and other UK authorities should be commended for their quick action to avert the potential disaster, and the proactive steps taken to ensure that no customer was left behind.